Hi there, this is Chris McManus from McManus Finance. Now, one of the major products that we offer our clients is VAT loans, and a lot of customers are now used to the process that we go through, but we thought it'd be quite useful to put together a little explainer video really as to how VAT loans work, what you might use them for, and what the cost implications are for you when you're planning whether to take advantage of this or not. So VAT loans very simply are a loan that will pay your VAT bill when it falls due. Most or almost every business now has quarterly VAT payments, and the reason this product has come to prominence is that it's essentially a cash flow tool, very much like invoice finance or a business loan might be. It's another way of leveraging the advantage of accessing cash, delaying payments for as long as you can to maximise the return that you'll have from having that cash on hand. The best way is to show you is to just work you through what a typical year would look like for a business with a VAT liability. Here you can see we've got a typical 12-month year, and we've got a quarterly payment cycle that many businesses operate on, which is this sort of January through to February quarter one, and then through each quarter, right the way through to the end of the year in December. Typically what happens is a business will trade through the first quarter of the year, January through to February and March, and will accrue a VAT liability that falls due for payment on the 7th of May. So you get 5 weeks or a month and a week at the end of your VAT quarter to make your VAT payment, and most businesses will be familiar with that cycle. And this pattern repeats through the year. So April, May and June, you're going to be paying on the 7th of August. July, August, September, you're paying on the 7th of November. So you get that 5-week delay from quarter end to when your VAT liability falls due. And you need to make that payment to HMRC, otherwise you're going to incur penalties, late payment fees, etc. So what the VAT loan allows you to do is when your VAT bill, let's say for quarter one, falls due on the 7th of May, the VAT loan will pay that payment for you on the 7th of May. So you get your payment to HMRC up to date, you don't incur any late payment fees or surcharges, but instead of all that money leaving your account on that day, the VAT loan will pay it for you, and then you will repay that loan plus the interest charge in 3 subsequent payments, 30, 60 and 90 days apart. So in this case, for a VAT payment that would be due on the 7th of May, you'd make your first payment on or about the 7th of June, second one on or about the 7th of July, and then the final one on or about the 7th of August. So essentially, all that VAT that was due or accrued here and was due there is able to be spread over an extended 3-month period. This gives a big cash advantage or cash flow advantage to businesses who may have other things they could use that cash for within the business and might otherwise have other ways of not raising those funds. Some people think that a VAT loan is only used if you can't afford to pay your VAT bill. Now, if that were true, most lenders wouldn't lend because they're not wanting to lend to companies that don't have the VAT to pay. What they see is that for many businesses, it's a cash flow challenge. They've got money coming in, it's just not with them yet, or they've actually got better ways of using that money within their business to help fund their business's growth. So don't think of it as a product that you would use in desperation. Think of it as something that you'd use as a cash flow tool, such as invoice finance, as a way of managing your cash flow properly. The way I often try and describe it is that you pay your staff probably monthly or weekly in some cases. Your rent and your rates and your fuel costs are typically monthly expenses. It doesn't really make sense why your VAT payment would be quarterly. It doesn't need to be. So doing it this way, you can break it down on a monthly basis and then get the advantage of having that cash available for you. So in terms of what that cost might look like, because this is something people often have concerns over, they don't know what the cost of it would be. So I provide a bit of an example here of typically what a cost of a VAT loan might look like. So very generally, and rates do fluctuate obviously, so this isn't precise, but it's a good guide. Generally speaking, around about 2% a month is what a VAT loan cost would likely be. So if your bill was £50,000, your options are to pay that VAT bill, let's say on the 7th of May, or to use the VAT loan to pay HMRC. You don't incur your surcharges, everything's up to date. And then you split that £50,000 over 3 monthly payments. 30 days, 60 days, 90 days after the due date. You'll be paying the capital amount split into 3, which of 50,000 would be £16,666.66p. Plus an interest element, so based on 2% a month, which would be 6% of 50,000, that's £3,000 interest, based on a 2% a month calculation. So the interest charge is around about £1,000 a month. So your payments would be 17,666 each month for those 3 months payments. So there's your cost, rough estimation, around about 2% a month. And you can see then the benefits that that would give you as a business then to keep that 50 grand in your account minimally for 30 days. And then obviously you're paying a chunk of that back on day 30. You've still got 32,000 available funds for another 60 days, and then a remaining 16 grand available for a further 30 days after that. So that's essentially what the cost gives you the benefit for. And yeah, a lot of businesses love the flexibility of this facility. The other thing that's important to note is that it's a facility that you can dip in and out of. So unlike other types of funding, invoice finance is a great product, but it does mean you're committed for a year at least on a contract, and sometimes you might not need the facility as much as other times. A VAT loan, the way we manage it with our clients is that we will reach out to you typically going back to our monthly cycle on a January, February, March quarter. So we're coming to the end of this. We're reaching out to you mid-April, around about 3 weeks before your VAT liability is due, to find out whether you're interested in taking advantage of a VAT loan at this time. We then go through that application process. A very simple process that we manage for you. And then when you're ready and with facilities agreed, we draw that down, get VAT paid on the due date, and then you've got your 1, 2, 3 months payments to repay that liability. So your cash position is improved greatly. If you use invoice finance, it's really useful to think about using VAT loans as an added cash flow tool for you. So that's VAT loans in a nutshell. If you've got any questions, contact us. We'd be more than happy to answer any questions you've got on the product, how it works, and anything else you might have around business funding. Many thanks.